My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. This market threw us a bit of a curveball today. I'm not talking about the uninspiring action. Dow dipping 23 points, S&P gaining 0.12%, NASDAQ advancing 0.54%. The real surprise was the pathetic action in the slowdown stocks. We got powerful evidence that the global economy is deteriorating. And what happens? The recession stocks, the soft good names that should be rallying, they rolled over. Let me walk you through this one. Last night, we got some devastating news from an outfit you may not have heard of. It's called BASF. It's a sprawling German enterprise from Ludwigshafen that's the largest chemical company on Earth. BASF makes all sorts of materials for semiconductors, cars, pesticides, consumer products. Hey, these guys are in practically everything. So it was a very, very big deal when this gigantic company said they might need to slash their full-year earnings forecast by 30%. Ouch! What did BASF cite as the reason for its grim outlook? Well, they blame weak car sales and weak crop sales and our trade war with China. It was a trifecta of woe. It's also a powerful reminder that the trade conflict hurts more than just American and Chinese companies. The damage is spilling all over the rest of the world. So now we've got real concern, real reason to be worried. While the Federal Reserve believes business is strong because we just got the terrific labor report last Friday, something that Fed Chief Powell might opine upon when he's on the Hill tomorrow, the weak forecast from chemical giant BASF suggests that the global economy might be in rougher shape than that employment number might indicate. And the cause of the weakness isn't going to go away anytime soon because the trade war, it's ongoing. Now, I suppose maybe some people want to call it a ceasefire. I was with somebody that called it détente. But I worry about how long that can last. Why? Simple. Even though President Trump extended an olive branch by rolling back some of the sanctions on that Huawei, that outfit that he thinks is a rogue telco company, I don't see anything from China to indicate that they're reciprocating. Where are the big orders, soybeans, corn, whatever? Hey, where are the merger approvals, like the one that Cisco will eventually need to close on its $2.6 billion acquisition of Acacia Communications that it made just this morning? We have no idea if the Chinese regulators will let this deal happen, even though there's no reason for them to block it, except as a chit in the trade war. Now, why does this matter? Because without any real movement from China, the trade ceasefire could prove to be ephemeral. I know we just restarted the official trade talks, and the White House made some positive noises today. But it seems like neither side is actually willing to budge much, and I always think we're one tweet away from a big sell-off. So can anyone offset this tariff-inspired weakness? Sure. There's always something else. When the industrials slow down, something else picks up the slack. That's the way the stock market works. That's how we could have a mixed day today, even though one of the largest companies on Earth reported an astounding shortfall. Now, I don't care why the slowdown is occurring. It is not really let's put it this way. The derivation doesn't intrigue me as much as all these other commentators are here. But think about it. Money managers and companies, they come on all the time, right, arguing about whether it's the Fed's fault for tightening too aggressively. No, it's the president's fault for rolling out so many tariffs. I mean, pick your own poison. But I will say that BASF sure didn't blame the Fed. They blamed Trump and China. Again, though, see, it doesn't matter. The important thing for you and me is simply recognizing that the slowdown does exist and then knowing how to react to it. And today, it sure seems real, and we got to learn how to react to it. For the longest time, when we got an industrial slowdown in this country, money would instantly rotate out of those industrial companies and into what we call the CPGs, the consumer packaged goods stocks. These stocks are safe. They're defensive. They're what you're supposed to buy when the economy deteriorates because you still go to the supermarket and buy these things. That's not what happened today. Last night, I told you that PepsiCo would be the key to this market. It was. I said if Pep reported good numbers and its stock rallied, it meant this group would be ready to roar. But the opposite? Well, let's take a listen. PepsiCo did not disappoint. I like the confirmation of this growth. I like the acceleration in both snacks and soft drinks. The stock jumped $1 in pre-market trading. But then the company took 16 questions on what I always tell you to listen to before you pull the trigger, the conference call. And it felt like the vast majority were critical critical in tone, mildly critical, some extremely critical. Not as constructive as I would have liked. The analysts picked this thing to pieces. Individually, it's really no big deal that Mountain Dew wasn't perfect, or that the company didn't nail its long-term algorithm, which is why Pep merely reaffirmed its forecast rather than raising numbers. Between the lack of a guidance boost and the sour questioning, the stock reversed, ultimately closing off less than $1, but it's really kind of nasty. And what happened is, from when you have that kind of reversal, it created a tremendous amount of negative pin action for all of the companies. When you think about the Proctors and you think about the Kimberleys, it's been a red-hot group. Suddenly, we lost our favorite place to hide, and BASF highlighted slowdown. Now, as I've told you over and over, money abhors a vacuum. So where did it go then? Simple. It flowed into the stocks of tech companies with fast growth that do not need a strong economy to make the numbers. These tech companies are all about making other businesses more productive, either using the cloud or big data or analytics. They'll do fine in a slowdown. Don't let your eyes glaze over. These are the modern day companies that I talk to you about all the time. It's where the money is, who fits the profile. Let's take it category by category. First, see, the Chinese don't like us. We don't like the North Koreans. The Russians are a pain. West Africa's got issue. Cybersecurity. Endless fount of opportunity. I saw big buying in Fortinet, Palo Alto Networks, and the red-hot Cramer family fave, Okta. To me, it seemed like much of the bullish action here stemmed from the analysts rolling out a positive coverage of CrowdStrike, the newly public cloud-based cybersecurity firm that's loved like few others in this brand new crop. Second, you've got the beloved payment processing stories. The cash is trash, digital is king stories. This group's led by Square today, SQ, which finally ignited after biding its time once the fabulous Sarah Friar left to run Nextdoor late last year. Square rocketed higher, up $4. Analysts recommended the stock. PayPal got in the action too. It's another one, WEX, W-E-X. No, not Brian Sullivan's excellent show in the morning. Something similar. WEX, except for it's a stock. I'm going to tell you more about it later, so stay tuned. Last night, I told you people would keep buying Amazon right ahead of this Prime Day, which is actually Prime 2 Day because they have 2-day shopping holiday. That's a perfect excuse to spend a lot of money. It's also a great reason to buy the stock for a trade, as long as you're ready to flip it to the next round of buyers, the Johnny-come-latelys who want to wait until they see the actual numbers of how Amazon Prime Days played out. Then there are semiconductor stocks. Well, they struggled mightily of late, but they're not getting a boost, perhaps because they're oversold. Maybe we're getting some of that positive chatter I mentioned about the trade war. Talk about lame. Again, I'm not too confident in these negotiations, so I just say, go buy Advanced Micro, go buy AMD, go Lisa Su. It's got the best chips. Growth managers always seem to buy it. We also saw money flowing into Western Digital, the Micron analog devices, all basic stuff. What else worked? How about defense technology and medical technology? L3Harris, the most technologically oriented of the major defense contractors, roared today. Hey, that's the combination of L3 and Harris that I talked about just last week, as did Edwards Life Sciences, the suddenly beloved medical device maker. I love them both. Finally, there's one, boy, remember when it was controversial? Facebook. The stock that keeps marching higher no matter what the media reports about their shady activities or congressional hearings or whatever. It doesn't matter, see, because between Facebook and Instagram, people can't bring themselves to quit their platforms. And as long as the users stay, the advertisers stay. Plus, I like what they're doing with Libra. They're kind of sort of cryptocurrency that's allegedly so controversial, mainly because it gives Facebook fintech exposure at a time when everybody loves financial technology. So you kind of have this playing all the way up here, all right? People love this. They're loving that. Bottom line, when investors start worrying about the global economy, and that BASF forecast was incredibly worrisome, one of two things happens. Either money flows into the slow and steady consumer packaged goods stocks like a PepsiCo, or it goes into the turbocharged growth stocks that can thrive in a slowdown like this list. Today's smoking hot growth won. Tomorrow? Who knows? Brian in North Carolina. Brian!
Jim, thanks for taking my call. I was calling you about CVS. CVS has revamped their business model, focusing more on healthcare products inside the store. They also have a pending merger with Aetna, which I think eventually gets approved. What's your take? Buy, sell, or hold?
Okay, I was in a very nice CVS today in a Target in my hometown of Brooklyn. I think that relationship, by the way, with Target is mutually satisfactory to both. I do think the Target is getting the, I don't want to say they're getting the better of it, but CVS has some rebate work that it's got to take care of. I think CVS, which is a big position for action alerts, is kind of biding its time, waiting for the judge to be able to rule about whether that's to break it up with Aetna. It's a good situation, not a great situation. It needs to get this court stuff cleared up. Oh my. Let's go to Jose in Texas, please. Jose.
Cramer, first-time caller here from Dallas, Texas.
Okay.
And my questions are regarding to Tesla. They have some solid Q2 delivery and production numbers, but two questions still remain. Can this company turn a profit, and does Elon Musk have what it takes to keep this company moving in the right direction?
All right. Here's my issue with Tesla. Again, I want to make this very clear. My daughter was in a Tesla this weekend, and she was so excited about it. She said, Dad, how about Tesla? How great. I mean, people buy the stock because they like the car, and I'm not going to get in their way. But that really is the reason, because it's shoring the balance sheet. Sometimes the market acts silly. Sure, the largest chemical company on earth reported an astounding shortfall, but other companies from these sectors can pick up the slack. Oh man, tonight, hats off to Red Hat and IBM. The CEOs of both companies join me here tonight after the close of the $34 billion deal, and it closed early. Then it's a new group of retailers rising to challenge Amazon. I'm revealing the names and whether you should be buying them right here, at least off the charts. And it's an under-the-radar fintech player that could be worth considering, a payment processor. I'll reveal the name. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.